Our last panel of the morning will focus on the very hot topic of mergers and acquisitions, consolidation in the shipping industry. Our moderator today is Nick Katsanos, partner in the law firm of Seward and Kissel in New York. Panelists are George Achniotis, CFO of Navios Maritime Holdings, Doug Mavrinac, Global Head of Maritime Investment Banking for Jefferies, Hamish Norton, President of Starboat Carriers Corp, and Tasos Psaropoulos, CFO of Global Ship Lease.
Thank you for that kind introduction. Hi, everyone. My name is Nick Katsanos. I'm a partner at the law firm of Seward and Kissel, where my focus is on M&A and other corporate transactions. On our panel, we'll get into a discussion about where things are going in terms of consolidation and M&A in the shipping industry. We have 4 great participants for this topic, and it's my honor to introduce them and moderate this discussion. So we have, in no particular order, George Achniotis, CFO of Navios Maritime Holdings, Doug Mavrinac, Global Head of Maritime Investment Banking at Jefferies, Hamish Norton, President at Starboat Carriers Corp, and Tasos Psaropoulos, CFO of Global Ship Lease. So welcome to all of you. I guess let's just jump right into this. I'll start with you, George. There have been a number of drivers of M&A and consolidation in the shipping industry over the last number of years. For example, at one point it was private equity shareholders seeking to exit investments, or at other times you've heard it's companies looking to become larger in order to make it easier to attract capital, and on and on. What do you think, in your opinion, will drive consolidation going into 2022?
Well, thank you, Nick. I think the same drivers that historically have driven consolidation will continue to be there into 2022 and drive consolidation. I mean, you mentioned private equity funds, and some of them have exited shipping or have exited part of shipping, but now we see them coming back. We have seen several transactions in the LNG space. Stonepeak bought DK LNG, KKR bought Ocean Guild, BlackRock has a significant stake in Gaslock. So private equity funds have not been away. They're just shifting from one side of shipping to another sector. And I guess they look at LNG as the fuel of the future. That's why they're investing heavily there. We also hear from banks that some private equity funds are looking to invest in crude tankers, probably because they see that as the next opportunity for rate recovery and valuation upside. Another driver or another element that has to be there to drive M&A activity, of course, is bank financing. And we see that there is availability of bank financing, especially from the German banks, which historically have provided a big percentage of shipping lending. They have cleared their balance sheets from their distressed portfolios, and they're there to do new business now. Also, Chinese leasing has been available, and it may become even more available now with the new monetary policies that the Chinese government has implemented. And of course, traditionally, another driver is economies of scale and diversification into multiple sectors. Again, in the past 5 years, we have seen a lot of, in the MLP space, a lot of GPs roll up their MLPs to create single entities, bigger entities. And within Navios, in the last year, we completed 2 mergers. Initially, Navios partners with Navios Containers, and then Navios partners with Navios Acquisition. For us, the rationale was compelling. In the past 2 years, we have seen extreme volatility in all sectors of shipping. And we have also seen that the sectors react counter-cyclical. They don't all go up or down at the same time. So by diversifying, you create a way to smooth out the volatility and improve the risk profile of the company. And diversification can give you an opportunity for better capital allocation, flexibility in corporate strategy and chartering strategy, and more predictable returns to shareholders. And with the 2 mergers, we aligned NMM to become a large diversified platform and become more attractive to long-term investors. we can capitalize cross-segment opportunities and provide more predictable returns to the stakeholders despite any specific sector volatility. And we see that as a proxy for the shipping industry as a whole. Companies can navigate the extreme volatility and the extreme cycles of shipping, and as I said, attract more long-term investors. And this is not something new in shipping. It may be new in the capital markets, but if you look at the most successful private ship owners, most of them have diversified fleets. And they do that because they are looking after the long-term viability of their companies.
Doug, anything you'd want to add to that?
No, I think that, Nick, thank you first off. I think George raised a lot of very interesting and good points in terms of, the investors that are potentially catalyst for M&A. It's not necessarily private equity. As George mentioned, you have a number of private equity participants getting increasingly involved. And so it doesn't necessarily need to be a private equity investor that is that catalyst. But I thought the final point that he was making is one that I think that we're seeing in a number of ways. And so, last year, 2021, Jefferies worked on 3 different M&A transactions, 2 of which were completed. The third did not reach the finish line. Whenever I look at what we're doing in 2022, there's another 3 that we're actively engaged on, and there is some diversification aspects to those M&A assignments. And so, we think that, in the mid-2000s, 10, 15, 20 years ago, you needed to be a pure play in order to get listed, and that's where a lot of the investor attention was focused. However, we think, with 10 to 20 years of public experience for investors, that, diversified models do make more sense. And when, I look at Navios Partners' acquisition of Navios Acquisitions, I look at the share response to that announcement, and not, like 1 or 2 people's opinions that they're publishing or discussing, but what did the collective market think of that particular acquisition? And the stock was up 20 or 30% within a month. And so we view that as validation of both the scale impact of that consolidation transaction, but then also the diversification, the third leg of a stool. So it's containers, it's dry, and now it's tankers. So I would just echo many of the things that George just mentioned.
I guess, Doug, in terms of, you mentioned some sectors. Are you seeing differences between sectors in terms of what we might see going into 2022?
Nick, I think that when we look last year, you saw international COAs acquiring Diamond S in the tanker market. We saw Navios Partners acquire Navios Acquisitions, which was another tanker acquisition, but it was a dry/container platform making that acquisition. The third that I referenced that did not finish reach the finish line was outside of both of those markets. So there was really no real single sector that was responsible for the consolidation. Whenever I look at 2022, we're seeing conversations in the dry world, in the gas world. We're seeing conversations that are really non-traditional shipping. So more kind of tangential or however you wanted to describe it. So I don't see any sector where it's like everything is taking place in dry or wet or containers. It seems to be more broad-based.
Okay. Tasos, anything you'd want to add to that?
I definitely agree with Doug on how it's been at least perceived by investors shipping as, in general, shipping. What I mean is the differences between sectors are there. What I mean is the supply demand is there. It's different in the sector. Even the carrying product is different, and the market dynamics of this carrying product is different. The readily available goods of containers with what the dry bulks are transferring all the oil of the tankers. Even the position of our customers is different. It's time. What I mean is that, for example, in liner business right now, and generally in containers, besides the rates and so the high rates and the high values that you see also extreme performance from our customers, which are now in much better position than they have ever been, with earnings visibility, with better balance sheets. In general, it may be perceived by investors as one sector, but the reality is that there are different drivers on each subsector of shipping.
Mm-hmm. I mean, I guess, Tasos, what do you think, what types of companies right now do you think are best positioned to pursue an acquisition, M&A or other types of similar transactions?
Like all the years, and it's not something different this year. Whoever has the capital and the cash and whoever has the access to the assets are companies that they are actually going to be able to make the acquisitions. And here we have 3 public companies that we have access to more capital than the private ones, for example. Last summer, we have used part of the consideration our notes. What I mean is that usually the companies that have the more cash and the more capital opportunities are the ones that can make the acquisitions.
Mm-hmm. George or Hamish, anything you'd want to add to that?
Well, I guess only that when we've made acquisitions recently, and I guess we've actually acquired something close to half of our current fleet in the last 3 years. They've been basically share acquisitions. A mixture of cash and shares, but the cash typically was about the same percentage of cash that we have as debt on our books, at the time, so that those acquisitions didn't really increase or decrease our leverage at all. And what was key was that the sellers wanted to take our share. So, in order to do a deal like that, you have to have a share that people want. And I think that's another characteristic of companies that can consolidate.
Yeah, I would agree with Hamish and also with Tasos. You need to be well capitalized in order to be in a position to transact. So you need to have optimal leverage and have a good cost discipline. Now, plus a management team with a good record with previous transactions, successful opportunistic transactions that has provided a reward to the shareholders. So if you have everything in place, then the valuation of the company, the share price of the company should reflect that at least over a long time period. And then you can use the share in transactions, in share for share exchanges, and end up with very accretive acquisitions.
No, that's really, I think, well put. I guess turning to you, Hamish, you've listened to a lot of this so far. You've seen a lot happen in the shipping industry over the years. In this current market, what do you think are the biggest impediments to getting deals done? Is it still the same issues that have limited consolidation in the past?
Well, there's nothing new under the sun here.
Yeah.
The things that impede consolidation are either the inability of buyers and sellers to agree on value, which happens a lot, or so-called social issues, where somebody is going to keep their job and somebody's not going to keep their job as a result of the consolidation, and the people who are not going to keep their job are not happy, and as a result, the deal might not happen. But this is true in every industry, in every time period. If something makes enough sense, there are ways to get around it.
And Nick, if I might be able to add, to Hamish's first point about, price paid, exchange ratios, et cetera, you may start saying NAV to NAV makes a lot of sense, but agreeing to what NAV to NAV is a multi-month process. And then whenever you make adjustments and everything else, so you may start with the best of intentions and the simplest of frameworks, but you can get into the weeds very, very quickly. Social issues, 100%. But the third thing that I would add is I mentioned this one transaction that did not reach the finish line last year. And, while even if you overcome some of the exchange ratio points and social issues, if there becomes a trust breakdown between both parties, there's nothing that can be done to salvage that M&A transaction. So alignment, not just with price paid, exchange ratio / social, but just trust alignment is, I think, extremely important because, we literally saw a deal fall apart in the second half of last year because the trust was broken.
Yeah. I mean, that's probably true in any deal in any industry, but it's a really good point. I guess, in terms of what's going on now, we've got inflation. We're all dealing with the pandemic still. Hamish, do you see any challenges on the horizon that might slow down?
Well,
besides what I just mentioned, I guess maybe those are the two main things, but
that might slow down consolidation, that might, because there are a lot of things that can slow down. Well, look, we've obviously got very strong markets in container shipping and pretty strong in dry bulk. Tankers less strong, and what can really slow down deal making of all sorts is where basically people have so much hesitancy about projecting the market that they don't trust anything about their own forecasts. In other words, it's interesting. You need a certain amount of disagreement about the future in order to get a deal done. The seller generally should be more pessimistic about the future than the buyer. But if you have too much lack of confidence in your own forecast, everything tends to freeze. Psychologically, people cannot transact. So, for example, in the beginning of 2020, I saw deal making just come to a complete standstill because nobody knew what was going to happen. And so they froze. And then, later on, as people stopped being frozen and started having normal disagreements about the future, the pace of deal making picked up. So, things that could cause tremendous uncertainty will maybe slow things down. So, what could slow things down? Let's look at the situation in Eastern Europe. Look at the situation in the South China Sea. These could cause tremendous uncertainty that might slow things down.
Mm-hmm. Okay. I guess just pivoting back to something George said before Tasos, in terms of debt providers, obviously they're a big part of any transaction in the M&A space. What have you seen, in terms of how they're viewing and reacting to M&A transactions, and are they cooperative? Are they working with you, and what have you seen so far?
Sorry.
Sorry, George, please.
I didn't hear who the question was.
Either one of you. Yeah, that's fine.
Okay. Our experience has been very positive in the last year. As I mentioned earlier, there is capacity from the banks, so they can provide financing and support transactions. And they have been willing to support both the M&A, the merger transactions that we did last year. They like it because eventually they managed to reduce their residual risk. They have better collateral, and they are comfortable lending into a much bigger entity with a lower risk profile. What was interesting is that they liked the diversification that we created. But what surprised us is that they also like having a diversified collateral package within their loan packages. Up to now, we knew if they wanted to lend in tankers, they only took tankers as collateral and so on. But now they like very much the fact that they have a diversified collateral package. And another thing that surprised us is that the banks that we have not done a lot of work in the last few years, the moment we announced the two mergers, they came to us offering us new financings.
Tasos, do you want to add anything to that?
Just want to mention is that in general, debt providers do not have an issue of any M&A if the counterparty is good, and of course the risk is not increased, or mainly if it's decreased, as George has mentioned. So for them, it's always a risk profile and a counterparty that makes sense. Now, if by any chance the M&A happens during a period where market rates are high, then better for them. And the cash flows are already or contracted or secured, or by any way they can foresee the market, things are much better.
So I guess I'll turn back to you, Doug. We just talked about debt providers, and that's obviously something that a seller or a buyer needs to consider. I mean, for either a seller or a buyer considering a deal, what are the other kinds of issues that they need to be aware of that could cause a problem in an M&A deal? Red flags and things of that nature.
Yeah, Nick, I think we discussed many of them already, where there was just not alignment. I mean, it's kind of one of those things where the red flags are kind of, not having them are prerequisites to even getting to the starting line. And so, as long as there's, a willing buyer and a willing seller, it's easier to get that sort of alignment. And when I say willing, I mean, the buyer may say, hey, look, we can generate $10 million in synergies. Why don't we have a conversation? And the seller may say, you know what, 10 million doesn't really move the needle for me to incur the kind of brain damage that I'm likely to incur. But, if you're talking about a seller that needs scale, and the things that go along with that, whether it's, better trading volumes, improved valuation, an ability to exit easier, then that's something where, that may matter more. So it's just, you need to have, I think, alignment on key variables as it relates to those sorts of transactions.
Okay. Hamish, anything you'd want to add to that?
Well, I guess, one way to create alignment that we've taken advantage of is to basically put the boss of the company you're acquiring on your board. We have we're a Greek shipping company, but we've got Arne Bleistad on the board, and we've got Raffaele Zagari on the board from Norway and Italy, respectively. And that's pretty unusual in this industry, but it's been helpful that we're open to that sort of governance, and it helps get deals done.
George, I mean, we've been talking about, M&A deals and consolidation, and there's always a focus, for as long as I remember, there's always been a focus on that at these conferences. Is there a downside, in your opinion, to consolidation for the companies merging or for the industry as a whole?
I think size matters for investors. So having a bigger entity through consolidation or merger, it should be positive for them. And as Doug said, we have seen it in our case with the share appreciation of Navios partners. One potential downside that I could see is that over the years, investors have been trained to look at pure play companies and invest in pure play companies. So now that we are offering something new, diversified company with different portfolio, more consistent returns, they may have, it will probably take some time for them to understand what we have done. And it will definitely take time from our side to educate investors and prove that we can deliver more consistent returns with what we have achieved.
Yeah, and I would contribute another downside to consolidation as simply that if you have a company that's set up to run, a certain number of ships and all of a sudden the number doubles, you need to be able to run double the number of ships. Not every company is going to be able to do that.
Yeah. Tasos, would you want to add anything to that?
Okay, being the result of actually a merger between Global Shiplease and Poseidon Containers, we have experienced the upside and the good thing. It was a successful merger, but during all this time, and Hamish is right, the operational risk and the strategy risk of a merger, it's always there that you need to tackle, you need to address, you need to find the sources, and you need all the parties to have the same pace also, to the same target.
Mm-hmm. Mm-hmm. Well, I guess, in any industry, there's always, planning ahead of time to make sure that the transaction is successful and focus on integration. I mean, Hamish, when you think about how to ensure the transaction is successful, I mean, what are the types of things that have been helpful for Star Bulk, or just generally, what do you think is important?
Well, we're typically pretty hands-on in the management of our ships, as I think the other shipping executives on the panel are as well. And so basically you have to have a plan for how to take over the management of the ships commercially, technically, operationally. And that's been core to our planning. And, some of that is having a plan to, take over gradually the management of the ships with some of the acquisitions we've done. We've actually left technical management of the ships with the entities that were doing it, before the merger, and therefore plan to transition over a period of years, if frankly ever. So, it's a matter of just making sure that, we don't have, emergency situations, let's say. You never want to have an emergency if you can avoid it.
Right. I guess one thing, I know private equity has been mentioned a few times so far. I mean, Doug, I'll ask you this question. What do you think private equity's involvement is going to be, going forward in shipping? Do you see them continuing to invest in any meaningful way, or, what do you think their role is going to be?
Yeah, Nick, shipping is a cyclical industry, and history always repeats itself. And so, I think you've seen private equity get involved at various points in time. And depending upon the duration of the fund life of whatever investment is being made, that may dictate, an exit time horizon. But as George mentioned at the beginning, you've seen a variety of examples very recently. I mean, in the conversations we were having with a lot of private equity investors over the preceding 2 or 3 years, most of those were seeking exits because they were in funds that had been involved in a while. But, as at the beginning of my comment just a second ago, it is cyclical and they will find opportunities. So whenever there's an opportunity to be had or exploited or profited from, I think you'll see smart money making an investment in that sector, whether it's more recently LNG or tankers, or in the past, dry cargo, where it took a number of years for the profits to be realized, but now they're being realized because of the strength in that particular market. So I think there will always be a role for private equity, always be a role for smart investors. And I think we're seeing a continuation of that with some of the more recent investments.
Yeah, I will just mention that the size of the private equity pool of capital in the United States is so large compared to the amount of capital that's needed in the shipping industry that to the extent private equity makes what they think are cyclically attractive investments in new buildings, they can kill any particular shipping market much faster than they think they can. And I think they figured that out in dry bulk, and let's hope they don't have to figure it out again in tankers.
Right. Yeah, there definitely is a lot of dry powder right now in the private equity world.
Yeah.
I guess one final question, and this has come up before. Some people have mentioned this. I mean, the impact of pools. You see some companies that enter into pools, and maybe they consider it as some sort of alternative to consolidation or M&A deal. I mean, Hamish, what's your view on that?
I mean, we're a member of a pool in the Capesize sector, and that gives us, better market intelligence than we otherwise would have, and I think probably better results. But it's not the same. It doesn't really do the same things as consolidation. It doesn't change your operating expense, which tends to be lower if you've got more ships. It doesn't change your overhead per ship per day, which tends to be a lot lower if you have more ships. It doesn't change the market cap of the company or the liquidity of the share, which are two things that are very important to investors and which are helped by consolidation. So I would basically go so far as to say that pooling is essentially completely different than consolidation, and can be a good thing, but it's a good thing in a different way.
Well, I think we've come up on our time limit. I want to thank all of you. I mean, we could sit here and I'm sure there'd be plenty of other things to talk about, but I want to thank all of you for participating, and I'm sure this has been really informative for everyone. So thanks, everybody.
Thank you.
Thank you very much.
So we'll now take questions from our audience. The first question is it easier to consolidate in a high market or a low market? Who would like to take that question first?
I'm happy to say a few words about it. I think most people expect that it's easier to consolidate in a high market where everybody's results are good and everybody's in a good mood. But, the truth is that what we found is that it may actually be easier to get people to accept our shares in a merger transaction with a fleet if the seller of the ships perceives that there's a lot of upside in the shares and in the market generally, which would be in a low market. And so actually, I think on balance, it may be easier in a low market.
And Nick, if I may add to what Hamish has said, with the diversified structure that we have set up, we can grow opportunistically. By this, I mean, we can take advantage of the cash flows of a sector that is in a high part of its cycle and invest in a sector that is in a lower part of its cycle. But again, I would agree with Hamish in what he said. It's not always necessary, or it does not always appear to the obvious that you invest in a class that is in a low part of its cycle. I mean, we just ordered a number of new build containers, which are at the top of their cycle. And provided you hedge your risk and your position, you can invest even at the top of the cycle. So we fix those containers for 5 and 7 year charters at very attractive rates. So by the time we get them back from the charters, their residual value will be very low. So the risk we are actually taking is very low.
And if I might be able to add to George and Hamish's comments, from the banking side, whenever you're having conversations with the other side's advisors, the other side themselves, and you're talking about future earnings, accretion, dilution, earnings impacts on future asset values, whenever rates are high and the market is strong, there's a greater opportunity to have a divergence of views as far as how long a rate's going to remain strong. if they start to, weaken a bit, how much are they going to weaken versus if the conversation was, well, rates are weak and they're bouncing along the bottom. And as Hamish mentioned, the argument is, how much upside exists and you're worried less about protecting your downside. It makes the conversations easier. It's easier to get agreement with both sides as it relates to valuation, exchange ratios, et cetera.
And the last thing is, if you have the more visibility that you have about the market, the easier it seems to be to make an investment, just from both sides.
Great. So our next question is, in terms of consolidation, how big is big enough?
I can say a few words to start out. There's a pretty famous index of small cap stocks. It's called the Russell 2000. And it's the smallest 2,000 stocks of the Russell 3000, which is sort of an index designed to mirror the whole market. And the average size of a company in the Russell 2000, which is the small cap index, is $3.8 billion. And, there aren't too many shipping companies that are worth $3.8 billion. Even in a strong part of the cycle. And of course, what you want is to be, $3.8 billion at the bottom of the cycle. And, that's basically our ambition when we grow up as a company. We want to be solidly mid-cap at the bottom of the cycle.
George, Doug, Tasos, anyone want to add anything to that? Or should we move to the next question?
I would take it from a practical point of view. And I think everybody would agree that size does matter in a company. Economies of scale exist. So the bigger number of vessels that you have, the bigger economies you can get. But at some point, these economies level out. There's so much you can get, so much discount you can get from the shipyards, from all your suppliers. And on the other hand, the structure within an organization could also set a limit in terms of the number of vessels that they can manage.
Yeah, no, I agree with George. It's very challenging for a shipping company to get as big as, say, 3.8 billion at the bottom of the cycle. The management structures and procedures have to be tailored toward a company of that size. But, frankly, if one wants to appeal to the bulk of the investment community, one has to be pretty big. Just, the market cap and the liquidity have to be big enough for the investors. And, I think the shipping organization, the management organization has to be able to deal with a company of that size, which is a challenge.
And the path to become sizable is not to be growth just in the sake of growth. It must make sense. Each transaction must be profitable, the earnings. So the size, of course, matters, but the path also to make the size, it's also very meaningful.
Okay. I think actually that may do it for us in terms of time. Thanks to everyone for your questions, and we'll now go back to the studio and Dave.
All right, excellent panel so far this morning. We're now going to break for lunch to sponsors, and the IRI breakout room is in the red button at 12:20, just underneath. It's already begun. It's just underneath the video player, the top red button. In the interim, we're going to go to the commercial sponsorships, and we'll be back in the 12:50 timeframe for technology and innovation in shipping.